Financial Pickle here, back again with another video. Cash secured puts and covered calls are very commonly used option strategies, especially with the growing popularity of a strategy called the wheel. But many traders are costing themselves money by trading them and they don't even realize it. The P&L chart actually looks the same for both trades, meaning you'll make or lose about the same amount of money in either trade no matter where the stock goes. But oftentimes one is a little bit better than the other in any given situation, which means more profit and less risk. But people often arbitrarily choose one or the other, or just follow a strategy like the wheel, instead of looking at the numbers to see which one is better in their situation. It's like filling up at the first gas station you see, instead of also checking the one across the street to see which one is cheaper. If you take the time to compare them, you could save some money. But in the stock market, the scale is much higher because you're often dealing with thousands of dollars or more. In this video, you'll learn how to identify the better trade, and there's also a spreadsheet that will make the job much easier for you. First, let's talk about how a cash secured put works. The idea is you sell a put option, which gives you the obligation to purchase the stock if the buyer of the option chooses to exercise it. And because it's cash secured, your broker will hold aside cash in your account just in case that option exercise happens. Here's an example. This is a 500 strike Adobe put that expires on September 22nd, 2023. If you sell this put, you have the obligation to buy 100 shares of Adobe at 500, which would cost $50,000. If you got 1,000 for selling the option, then that 1,000 plus 49,000 that was already in your account would be held aside in case that $50,000 purchase needed to happen. The maximum profit is 1,000, which would happen if Adobe finished above 500 on the expiration date. The maximum loss is 49,000, which would happen if the stock went to zero. Now let's take a look at a covered call example with the same 500 strike. Buy 100 shares of Adobe at 530 and sell a 500 strike call at 40, which gives you the obligation to sell your shares at 500. The maximum profit is 1,000, which would happen if Adobe finished above 500 on the expiration date. The maximum loss is 49,000, which would happen if the stock went to zero. See any similarities here? Like I said before, the P&L chart for a cash secured put and a covered call look the same. The max profit happens when the stock is above the strike at expiration, and you can lose money all the way down to zero. And no matter what price the stock is at, you end up with the same position either way at expiration. With the cash secured put, if the stock finishes below the strike, you are forced to buy the shares and you'll have a long stock position. With the covered call, your short call will expire worthless and you'll still have your long stock position. With the cash secured put, if the stock finishes above the strike, your put will expire worthless, which leaves you with no position. With the covered call, your short call would get assigned and you would be left with no position. So effectively, they are both almost the exact same trade, just under different names. But the big difference between them is how much cash is changing hands on each one. In the cash secured put example, you're receiving a $1,000 credit. In the covered call example, you're spending a $49,000 debit. This is a $50,000 cash difference between the two trades, which is factored into the option premiums. There is value in having that extra cash because you can invest it and earn interest, or use it to lower your margin balance if you have one. So my examples actually aren't realistic because that interest isn't factored in. Here are the actual numbers from the close of August 28th, 2023. Now, with the cash secured put, your max gain is $958, your max loss is $49,042, and you're getting a $958 credit. And with the covered call, your max gain is $1,148, your max loss is $48,852, and you're spending a $48,852 debit. The max gain on both happens above the 500 strike, and the max loss on both happens at zero. But the covered call is gaining 190 more or losing 190 less. This is because of that cash difference I talked about earlier, which is now $49,810. Because of the extra cash you get with the cash secured put, it will have a lower return versus the covered call, but it can be offset higher by the interest you would get from investing that $49,810. Or another way to think about it, the covered call will have a higher return, but it's offset lower by the interest you would pay to borrow that $49,810. The interest rate the options market uses in these calculations is called the risk-free rate, which is the theoretical rate of return you can expect on a zero-risk investment. Generally, U.S. Treasuries are used for this because there is theoretically zero chance the government will default on their debt, When you factor in the interest on that 49,810 cash difference based on the risk-free rate, the returns on the two trades end up being roughly equal. Let's calculate it so you can see for yourself. On August 28th, these options had 25 days left until expiration. If we take 25 days left divided by 365 days in a year, then we get about 0.0685 years left on the options. For the risk-free rate, you want to look at US Treasuries with the same amount of time left as your options. So for my example, I'll look at 4 weeks, which had an interest rate of 5.42%. To calculate the interest we would earn on that 49,810 cash difference, we would multiply it by the 0.0685 years and the 5.42% interest, which gets us $184.93. This is almost exactly that $190 difference we saw earlier, but a small difference is expected because of the bid-ask spread on the options. Or another way to look at it is you can divide the $184.93 by 100 to convert it to an options price, because each contract represents 100 shares. Then take the $1.85 and add it to the time value on the put, and it should be roughly equal to the time value on the call, which means the return on both trades would be equal. And the delta values on the positions are the same as well, which means when the stock moves, the profit or loss on both positions should be roughly equal. The delta value on the put is negative 0.2637, but because we're short the put, it becomes positive 0.2637. And on the covered call, the delta value on the long stock is 1, and the delta value on the call is 0.7355. But because we're short the call, it becomes negative 0.7355. When you add those together, it becomes 0.2645, which is basically the same as the cash secured put. But the theta numbers are actually very different, and for those that don't know, theta is the time decay per day on the option. On the cash secured put, the theta is negative 0.348, and on the covered call, it's negative 0.4228. They're different because, just like I explained before, the market expects you to make up the difference by earning the risk-free rate on the 49,810 cash difference. We can slightly modify our formula from earlier to do the calculation. Because theta is per day, we want to calculate just 1 day's worth of interest. So that's 1 divided by 365 times 5.42% times 49,810. Then we divide by 100 to convert it to an options price. That gives us about 0.074. When you combine that with the theta on the cash secured put, you get negative 0.422, which is basically the same as the negative 0.4228 on the covered call. So for right now, the formula we can use to determine the superior trade is the time value on the cash secured put plus interest on the cash difference based on the risk-free rate, and that should equal the time value on the call. And as we continue, I'll make adjustments to this until we eventually get to the final formula. So, where lots of cash secured put traders cost themselves money is by not receiving the risk-free rate on the cash being held aside to secure their put. This generally happens because brokers pay less than the risk-free rate on idle cash. And this has become a much bigger problem lately because the Fed has raised interest rates substantially, but many brokers have barely raised their rates at all in response to that. So the difference between the risk-free rate and what brokers pay you is several percentage points in some cases. Because of this, you would end up getting a lower return than what you would otherwise get on a covered call with the same strike. So rather than doing a cash secured put and letting your cash sit there, it's usually more advantageous to buy the shares and do a covered call with the same strike that you would have done the cash secured put on. However, there are a couple of ways to earn more money on your idle cash which will help even the playing field. I'm not too familiar with how other brokers do it, but at Charles Schwab, in addition to cash, you can also secure a short put with a money market fund or a US Treasury maturing in less than a year. One potential problem with money market funds is their yields are based on what's on the short end of the yield curve, usually about 30 to 60 days out. But in options, the risk-free rate being priced in is based on the duration of the option. And most of the time we have a normal yield curve, which means the longer the duration, the higher the interest rate. This won't really affect you if you do short-term options, but if your options go out more than a few months, then the yield you get on the money market fund will likely be less than what the options are pricing in. But right now the yield curve is mostly inverted, which could work out in your favor depending on the duration of your options. And the yields on money market funds are heavily correlated with the federal funds rate and can change any time. Whereas on your options, once the trade is executed, your price is locked in for the whole duration. Another problem with money market funds is they have a fee called an expense ratio, which is the annual cost of managing the fund. After that fee is taken out, the return ends up being lower than the risk-free rate. For example, let's look at SNVXX, which only invests in securities guaranteed by the US government. The yield is 5.04% and the expense ratio is 0.34%. The yield already factors in that fee, so if the fee wasn't there, the yield would be 5.38%. And if we look at Schwab's most popular money market fund, SWVXX, the expense ratio is also 0.34%, but the yield is slightly higher at 5.22%. Now, money market funds in general are extremely safe, but SWVXX has a slightly higher yield and is slightly more risky than SNVXX because they invest some of their money into riskier assets like corporate debt instead of only government debt. But the 5.22% is still lower than our risk-free rate from earlier. Treasuries will give you pretty much exactly what the risk-free rate is because they are the risk-free rate, and the fees are generally very low or non-existent. One potential problem, however, is that they can fluctuate in price, whereas a money market fund will basically always stay at $1 per share. If interest rates go up, treasuries will go down and vice versa. So if your cash secured put gets assigned early, you'll need to sell your treasury to pay for the stock. This means you might get a slightly unfavorable price because of the bid-ask spread, and your return on that treasury might be a little bit less than the risk-free rate if the interest rates went up since you bought it. So now we can add the interest loss due to earning less than the risk-free rate into our formula, which will make covered calls superior to cash secured puts. Now, this whole time with puts, I've only been talking about cash secured puts. So you might be wondering, how does anything change if your puts aren't cash secured, like a naked put, for example? Either way, options factor in the risk-free rate. As rates rise, calls will go up in price and puts will go down, and vice versa. But if you don't have cash to invest to help equalize the returns between the naked put and covered call, then they are already equalized by default. Like I said earlier, the covered call has a higher return, but can be offset lower by the interest you would pay to borrow the cash difference between the two trades. So rather than borrowing cash to do a covered call, you can just do a naked put and the interest adjusted returns would be the same. And as a side note, it's very easy to invest your extra money at or close to the risk-free rate, but your options are a lot more limited when it comes to borrowing money at that same rate. Brokers will often charge several percentage points higher to borrow on margin, but there is an option strategy that lets you borrow at close to the risk-free rate. If you're interested in learning about that, click on the link in the description down below. Something else we have to take into consideration are dividends. As you probably know, when a stock has an ex-dividend date, it will adjust down by the amount of the dividend. This downward adjustment is factored into option premiums, which makes calls worth less money and puts worth more money. And with a covered call, you get the dividend because you own the stock, but with the cash secured put, you don't. So if the underlying stock has an ex-dividend date before your option expires, you have to factor that into our formula to make an accurate comparison between the two trades. Here's an example for SLB as of the close on September 1st, 2023. They have an ex-dividend of 25 cents on September 5th before the option expires. If we do our calculation from earlier, it gives us about 6 cents of interest per share on the cash difference. Then add the 76 cents of time value on the put to get 82 cents. Now normally that would equal the time value on the call, but it's only 57 cents. But when you add the 25-cent dividend, they become equal. So here's another updated formula that now includes dividends. And the final piece of our formula is related to hard-to-borrow fees. This is a fee you pay to short a stock when there aren't a lot of shares available to borrow. And it might sound strange for that to affect our trades because we aren't shorting any stock in either one, so let me explain. Options will almost never factor in an interest rate higher than the risk-free rate, because then there would be an arbitrage opportunity. For example, let's look at our Adobe options from earlier and pretend the call option is more expensive. This means you would have to earn more than the risk-free rate on the cash difference between the two trades to equalize their returns, which means the call is overpriced, the put is underpriced, or both. To take advantage of that, you can do a synthetic short stock, which involves selling an at-the-money call and buying an at-the-money put. This will pretty much do exactly what a short stock position would do. Then you would offset that by buying the shares, which would result in a neutral position and risk-free gains higher than the risk-free rate. The profit would end up being the risk-free rate on the money you spent, plus the extra amount above the risk-free rate that the options were pricing in. If these were the real prices, then traders would quickly take advantage of it and the arbitrage opportunity would go away. But on the other hand, if the options are pricing in an interest rate lower than the risk-free rate, then that means you can earn less than the risk-free rate on the cash difference to equalize their returns, which means puts are overpriced, calls are underpriced, or both. You can take advantage of that by doing a synthetic long stock, which involves selling an at-the-money put and buying an at-the-money call. This will pretty much do exactly what a long stock position would do. Then you would offset that by shorting the shares, which would result in a neutral position. Then if you invest the cash credit at the risk-free rate, your profit would be the interest on that cash based on the amount below the risk-free rate that the options were pricing in. But in this case, it's not necessarily risk-free gains because you might have to pay a hard-to-borrow fee to short the shares. So the hard-to-borrow fee allows puts to be overpriced by the amount of the fee because that fee takes away the arbitrage opportunity that would otherwise exist if the fee wasn't there. There are also some situations where there are no shares available to short at all, which obviously also takes away the arbitrage opportunity. This works in favor of cash secured puts and could make them superior to covered calls in some situations. Here's an example on VFS from September 1st, 2023. Just at face value before doing any interest calculations, we can see that the cash secured put is far superior to the covered call, and it would be even more after we add the interest on the cash difference. But this is an extreme example, and the superior trade usually won't be this obvious. And here is our final formula with everything included. So to summarize, cash secured puts are generally inferior to covered calls when you're not earning the risk-free rate on the cash being held aside. And covered calls are generally inferior to cash secured puts due to hard-to-borrow fees on the underlying security, which allows puts to be overpriced. So this clearly means that the wheel strategy is not an optimal way to trade. The strategy tells you to do the trades in a specific order rather than looking at the data to see which one is superior at the time. This means you're often leaving free money on the table. If you own shares and planned on doing a covered call, it might instead be more advantageous to sell the shares and do a cash secured put instead. Or if you plan on doing a cash secured put, it might be more advantageous to buy the shares and do a covered call. You won't know until you run the numbers. So let's take a look at the spreadsheet I made to help us with the calculations. Simply enter the variables in the boxes highlighted in gray, and the spreadsheet will do all the work for you. There's a lot to cover with it, so I also have a part 2 of this video where I explain the spreadsheet in a lot more detail with several different examples. If you're interested, the link is in the description down below. Thank you so much for watching. If you enjoyed the video, please give me a like and subscribe, and let me know what you think in the comment section down below. Financial Pickle, keeping you out of the pickle jar.